Today, we are stepping into the role of a foundational advisor for a new business. We're going to explore the financial blueprint for one of the most common business structures, the partnership. Our focus will be on how to properly account for the initial capital contributions that bring a new business to life. It often starts with a great idea and a handshake. For many entrepreneurs, a partnership seems like the American dream. It's fast, flexible, and has significant tax advantages. We see it everywhere, from local coffee shops to massive global firms like PwC. But this simplicity comes with real peril, unlimited liability and mutual agency, which we've discussed. The partnership agreement is the legal blueprint designed to manage these risks. Our job as accountants is to translate that blueprint into a solid financial foundation. The first step in building our partnership is laying the bricks, the initial capital contributions. The golden rule here is the rule of fair value. While cash is easy to value, any non-cash assets like buildings, inventory, or equipment must be recorded on the partnership's books at their current fair value, not the partner's original book value. Why? Because the partnership is essentially acquiring these assets from the partner. To be fair to everyone involved, we have to value these contributions based on what they are worth today. And of course, if a partner also brings in debt, like a mortgage on a building, that reduces their overall capital contribution. Now, we get to the heart of partnership accounting and the most strategic decision our new partners, James and Joyce, will face. What happens when a partner's most valuable contribution isn't something you can touch? In our scenario, James contributes $70,000 in cash, while Joyce contributes only $10,000. However, Joyce is an accomplished graphic artist. Her talent and reputation are the real reason clients will come to their new advertising agency. The dilemma is this: how do we make their capital accounts equal as they agreed when one partner's main contribution is intangible? We have two primary methods to solve this: the bonus method and the goodwill method. The bonus method is the conservative, straightforward approach. Its philosophy is, let's not guess the value of talent. Let's just work with the tangible cash in the register. Here's the mechanic. The total tangible capital is $80,000 from the combined cash contributions. Since the partners have agreed to have equal capital balances, we simply split that $80,000 in half, giving each a $40,000 capital account. The result is that Joyce receives a $30,000 bonus from James's cash contribution to recognize the intangible value she brings to the business. It's a simple, direct transfer of capital between partners. The goodwill method is more aggressive and forward-looking. Its philosophy is that Joyce's talent is a real economic asset, and it should be on the books. We call this asset goodwill. Here's how it works. We infer the value of Joyce's talent. If James invested $70,000 for a 50% stake, the total implied value of the new firm must be $140,000. Since the firm's tangible assets are only $80,000, the missing intangible value, the goodwill, must be $60,000. With this method, we record goodwill as an asset and credit Joyce's capital for her cash contribution plus the full $60,000 value of her intangible contribution. So, which blueprint is better? There's a significant debate here. The bonus method is conservative and objective because it only deals with tangible assets. However, it understates the true value of the partnership. The goodwill method attempts to reflect the true economic value, but it's highly subjective. It creates an asset out of thin air, with no historical cost or verifiable market price. For this reason, while both methods are permitted, professional skepticism and GAAP principles lean heavily towards using the bonus method in practice. It's considered the safer, more defensible choice. Finally, Let's look at what happens after the partnership is formed. A partnership is a living entity, and its capital structure is dynamic. Partners can make additional contributions later on, perhaps to fund expansion or cover a cash shortage. This simply increases their capital account. Conversely, partners can also take withdrawals, often called drawings. These can be periodic payments like a salary or larger, one-time withdrawals. These drawings decrease their capital account. Understanding how these activities flow through the capital accounts is key to tracking each partner's stake in the business over time.